Hi everyone. So we are continuing with the next topic of financial management. If you remember, when we started with financial management, we did three decisions. One was investment, the other was financing, and the third was dividend decision. And before that, I talked about objectives of financial management. I told you sums: sufficient availability of funds, utilization of funds, maximization of owner's wealth, as well as safety of funds. And I told you I'll explain you why maximization of owner's wealth take place. Ultimately, once we finish off with the decisions, we'll be able to understand them better. If you remember, investment decision, we talk about long-term assets and short-term assets. Financing decision, we talk about quantum of finance, that is proportion of owner's fund and borrowed fund. And dividend decision, we talk about whether to retain profit or to distribute it as the dividend to the shareholders. Now, considering all three dividends or considering all three decisions, we talk about what is the primary objective or aim of financial management. This question usually comes for 4 marks in the board, and that is why I am covering it separately for you all. Right. The primary aim of financial management is to maximize shareholders' wealth. So, if you remember, I made the acronym sums, sufficient availability of funds, utilization, maximization. So, out of SUMS, this M is for maximization of owners' wealth. The market price of a company's share are linked to three decisions. First, vis-a-vis investment decision, financing decision, and dividend decision. Why this happens? Because this is because companies' funds belong to the shareholders, and the manner in which they are invested and the returns earned by them determine their market value and price. See, it's a very simple fundamental thing about the market value of the shares. When you invest money and you get return, and you're able to pay off your creditors, you're able to pay off your debenture holders, you're able to pay off your vendors and suppliers or anybody you have in mind, and even the equity shareholders get return, that means all are being paid off, company earned enough profit, the equity shareholders are also getting dividend, so that is dividend decision. And when you borrowed when you're paying off the debenture holders, that means you're using your own money as well as debenture holder, so that means you're talking about financing decision, and this is about investment in the business. So all three decisions are taking place, and they are proving gainful. Why? Because you're getting enough money to return to all the people. So all the people, when they get their money, and equity shareholder who are residual claimants who get the leftover after all people have been paid off, if they are also getting their return, that means company is doing well and the decisions have proved gainful and they have been taken righteously, and they have led to increase in the market value of the equity shares. It means maximization of market value of equity share. The market price of equity share increases if the benefit from decision is more than the cost. So all the decisions are which? These decisions are the investment, financing, and this dividend decision. So if you talk about decision out here, financing, investment, and dividend decision. Okay. Each decision is all financial decision aim at ensuring that each decision is efficient and adds some value to the market value or market price of the equity share. Such value leads to increase in price of equity share if all creditors, debenture holders are getting paid, and the residual claimants, equity shareholders, are also getting returns. It means there is an increase in the market value of share, that is your equity share, thereby leading to maximization of owner's wealth. That is the concept of maximization of owner's wealth. I usually take up this topic once I take up all the decisions, because by now you know what are the factors affecting all the three decision: investment, financing, and dividend decision, what are the definitions and how they affect the decision regarding financial management. Another important topic which we need to do is the role or importance of financial management. Now, role and importance of financial management will not be clear until unless we know about the decisions, we know about the primary aim, we know about what is financial management. We have done financial management, we have done all the three decisions, we have done the primary aim or objective of financial management. Next we are coming to is role or importance of financial management. The first point says the size and composition of fixed asset. Now, financial management role or importance, that means why is financial management required? If an organization is very small, if you talk about a thelewala, okay, a vendor, hawker rather. If you talk about a hawker, what is his investment per day? Maybe 1000 rupees, 500 rupees. Does he need a financial manager to manage his things? No. So the size and the composition of fixed assets determine how you need financial management. How? Some invested in fixed assets is more, some invested in fixed assets is less. So business is very large and business is small. A capital budgeting decision to invest a sum of 100 crore in fixed asset would raise the size of fixed asset blocked by this amount. Therefore, more financial management will be required. Financial management will be needed in a better manner to manage the business. Next point. The quantum of current assets and its breakup into cash, inventory and receivables. Receivables, we are talking about bill receivables out here. Now, your fixed assets are more, your working capital is more. Your fixed assets are less, your less working capital. Of course, yes, small business, less working capital required. Now, the quantum of current asset is also influenced by financial management decision. Of course, yes. Fixed assets more, working capital more, fixed assets less, working capital less. Now, what you do is that you give a long-term credit. So, if you give long-term credit to your customer, you will have debtors. You will have more debtors. That will affect your current asset decision. If sometimes those debtors might give you bill receivable, again you give long time, instead of giving them 3 months of minimum time, you give them more time. Again you will have more of current assets. Sometimes you may just not sell on cash basis, stock may lie there. Again you have more of current assets. So if your business is very big, sometimes your money actually gets stuck up in the current assets. So decision about credit and inventory management affect the amount of debtors and stock, which will affect composition of current assets. Therefore, financial management is needed. Financial management is needed to manage the complete business. We are talking of financial management role or importance in terms of a business which is very large in size. First, when you need more of fixed assets. Second, the size of the business is big. Second, with size of the business being big, if more fixed assets, more working capital and sometimes more of current assets, then the financial management is required by the business. So next point is the amount of long-term and short-term funds to be used. Long-term funds, short-term funds. So a firm, when it talks about long-term funds, suppose you're taking loan for longer time and you borrow money for shorter time. Now, what is cheaper for you, current liabilities or long-term liabilities? Here, current liabilities cost less than long-term liabilities. Of course, when you will keep on paying loan, interest on loan for 5 years, that would cost you more in comparison to when you pay for the bills payable, or when you just pay a very little in case the bill gets dishonored and then you pay the kind of interest, or you're borrowing for short-term overdraft, interest is very less. Initially it is not there. So a firm wanting to have more liquid assets, if you want more of liquid assets, would raise on a long-term basis. Why? Because they want liquidity, convertibility into cash. They say that whatever funds are there, we would not like to block them, we would like to you keep on using them, and we'll keep on paying little amount as interest every month, and will use it for a longer time, because what they want is they want more of liquid cash in their own hand, as there is a choice between liquidity and profitability. So here current liabilities cost less than long-term liabilities. So financial management is needed for this purpose also. Next, breakup of long-term financing into debt and equity. Now, when you talk about debt and equity, which is a cheaper source of finance, debt, which is an expensive source of finance, equity, the proportion to be raised a part of financial management, therefore it is part of financial management, therefore it is important. You need to decide the proportion. If you remember, the quantum of debt and equity we talked about was in which decision? Financing decision. So if financing decision is important, financial management is important, because you need to know which is a cheaper source, which is easily and timely available to you, and whichever source is easily, cheaply, timely available to you, that kind of source you use. So financial management is required to decide this. All items in profit and loss account, like if you talk in terms of all items in profit and loss, account T out here. Okay, all items in profit and loss account, for example interest, expense or depreciation. Now let's get very clear. If debt is more, interest will be more. If equity is more, you pay more dividend. Now this is your choice. This is your choice. If you have enough profits, then you pay dividend. If you don't have, you can pay dividend next year. But whatsoever happens, interest has to be paid. You can't avoid that. Now, an expansion of business is a capital budgeting decision which will affect items like depreciation on assets, kharcha, other expenses apart from interest. So if you have depreciation as a kharcha, then you have other salaries and all other items of P&L account, salaries, discount and electricity and whatever comes in the P&L account, and also added up interest. Financial management is required to manage everything. You cannot just simply work the way you feel like working. So when you talk in terms of debt and equity, either here, when you talk about the long term funds or short term funds here, when you talk about debt and equity here, all you need to know is that all the three places financial management is needed. Now, next is financial manager. What does he do? The functions of a financial manager are he takes all avenues of investment, he discusses, he sees what are the various ways he can raise finance, taking care of modes of financing, how you can actually get easy, cheaper, best available finance, helps in ways of handling various components of working capital so that money is not wasted, and he manages the cash efficiently so that again the firm does not waste or does not have idle funds or does not put funds in the wrong place. This is all about introduction to financial management, its importance, the decisions. Next we'll be covering up is financial planning, and apart from financial planning, then we'll be talking about capital structure, fixed capital and working capital. So till then, bye bye.